Hey guys, thanks for tuning in to another episode of Nuggets News. Today we've got a special guest, an Aussie investor. He's the CEO of Motley Fool, which you've probably heard of. So thanks for joining us today, Scotty.
Pleasure, good to be with you.
Now, you've got some differing views to myself, and it's always great to have these conversations, and we try and give unbiased information where we can. So for
Yep.
those that haven't followed your work, what do you do, and how did you get into the Motley Fool?
All right, so I'm the Chief Investment Officer of the Motley Fool. I've been working for the company now for about 8.5 years. So I've been around effectively since we opened our doors in Australia. The company was started in 1993 in the US by the Gardner brothers. We opened our Australian office in 2011, and I was employee number two through the door. Now, 8.5 years later, CIO of a big and growing team. We provide investment advice when it comes to primarily shares, people would know us for. We do give sort of general personal financial advice and sort of financial commentary, but stock picking is our starting point. Before the Fool, I worked in the industry, so I came from an FMCG background, fast-moving consumer goods.
Yeah.
I worked for some of the big brands, Blackmores, Heinz, Diageo, the alcohol business, an Australian importer of Lavazza and Dilmar and Soretta tuna.
Yeah.
So I kind of came from industry before then, always had an interest in shares. I found the Motley Fool way back in 1998 as a member, as a reader,
Yeah.
and then fast forward 13 years and I joined the company.
So I guess, I'll be a little bit off topic before I get into the questions I had for you. That's interesting if you've been with or reading the Motley Fool since that .com bust and then the GFC.
Yep.
What are maybe your takeaways, or what did you learn during those times?
Yeah, I mean, look, I'll be a bit of a broken record, and hopefully, if anyone is familiar with our company, they won't be particularly surprised by what I have to say on that one.
Yeah.
This too shall pass, and it sounds a bit blasé, and for people who want to be more active and more tradey, that's kind of not our thing. And so I get, for some people, they'll say, well, we have opportunities to buy, sell, and do other things, and that's completely fine for those people.
Yeah.
As a long-term investor, and I kind of was schooled by the Fool, so to some degree, there's no surprise that my views are pretty well aligned and why I wanted to join the company in the first place.
Yeah.
Having seen them come and go, that's almost the point, right? In the depths of despair, in the worst of times, it feels like everything's terrible. In the good times, it feels like everything's great. The fact that both happen and reasonably, in reasonably quick succession is probably the big takeaway. That if you take a longer term view, if you are a long term investor, even those bumps, you look back at a 30-year chart of the ASX, for example, or the US markets, those big rises and crashes almost are hard to find. Try and find the 87 crash. It's almost imperceptible at the bottom left-hand corner of that graph.
Yeah.
Same with .com, that was huge at the time. GFC, huge at the time. And they were big in percentage terms. But the fact that compounding kind of takes care of all of that over time, with some caveats. I'm not, again, saying anyone should recklessly just invest in anything, anytime, for any length of time.
Yeah.
But generally, this too shall pass is probably the key takeaway.
So your general investing thesis is that over time, business continues to grow, population increases, charts are going to go up and to the right as a general rule of thumb.
Yeah, look, and that's always been the case. I mean, I guess there are some people who will say, and probably some people who are watching now, who will say, yeah, but this time it's different. And maybe that's the other thing, right, is John Templeton back in the, whatever it was, 1910s or something, said the four most dangerous words in investing are this time it's different. And I think, for me, that's historically been true. Now, maybe we are at the one and first turning point where it doesn't remain true after that. But for the long-term investor, I think that's exactly right. There's no reason to believe that if you believe in kind of the human ingenuity of democratic capitalism, which sounds a bit kind of buzzwordy, but if you kind of break that down, people will keep making new and better things. The Apples, the Amazons, the Facebooks, the Pro Medicuses, the Nanosonics of the world.
Yeah.
These are companies inventing new and better ways of doing things. That drives society. It drives profit for share owners. And so if you kind of roll that forward, I mean, it's a brave person to say that there'll be hiccups, absolutely. Am I saying it'll be up and to the right without falls? Absolutely not.
Yeah.
But broadly speaking, yeah, that's my view, is that we will see growth over time because companies will continue to invent new stuff, profits will grow, and shareholders will get richer as a result.
Yeah, and we've definitely noticed that it's one of the best times to be alive in terms of standard of living, life expectancy, disease. So I know a lot of time we worry about what's going on with the debt and whatnot, but I guess that leads to the question though: is software and AI and that sort of eating the world and taking a lot of these jobs? Maybe things get a lot better, but are there those base jobs? Is that something you've thought about much?
Yeah, look, it is, and I mean, I'm an optimist by nature, right? So I've said to people for the longest time, I think history says it's more profitable and more successful to be optimistic and be occasionally wrong than pessimistic and occasionally right? So for the GFC, for the .com crash, for the 87 crash, back to the 70s, the oil shocks, we can go back as far as you want, and some of your viewers will be old enough and some won't be to remember those things.
Yeah.
The reality is that over time, despite those things, the market's grown, and that's kind of the point, right? There's no absence of those, but it's a despite. To your point about jobs, I think you look back to agricultural, England. with the introduction of the spinning jenny that all of a sudden allowed cotton to be produced on a mass scale.
Yeah.
And that was the end of work. Back to the early 1900s, when 80% of Australia's economy was agriculture. And if you'd said, well, by 2019, only 5% of the country's workforce will be in agriculture, you would say, well, where are the other 75% of jobs going?
Yeah.
And the answer is that the very nature of kind of the reinforcing cycle of economics, of the economy, creates jobs as it destroys them, right? As something else becomes more profitable for someone to do, they do that job and they leave the other job that's less profitable to do. That's kind of what happens. And if you have technology that creates an interesting or expanding standard of living, I should say, that money gets spent somewhere. So it's no surprise over the last century, we've seen a huge boom in service jobs, in software itself. The fact we're talking on computers over an internet, we've got mobile phones in our back pockets, those things didn't exist, right? And so I have every confidence, quite frankly, and maybe, again, I can be accused of being a Pollyanna, and maybe that's true to some degree.
Yeah.
But again, history, since the Industrial Revolution, every new technology has been feared. Back to the Luddites in their caves, everything was going to destroy the world. And if you look back, it's like, man, if you'd been worried about that stuff at the time, it really would have been an expensive loss.
Yeah.
I have no doubt that for the foreseeable future, anyway, for my lifetime, I literally believe it because I'm investing accordingly.
Yeah.
The rest of my life, I believe the economy will create jobs to replace those that are being eaten up, simply because people have disposable income. And if you're spending less on agriculture, spending less on manufacturing, then you're going to spend more on the Netflixes or the Facebooks or whatever you want to spend your cash on. That's where the money gets spent.
Fantastic. So let's get to Australia. So we've had this fantastic streak. I'm not sure if you saw, we did a bit of a documentary about how we did have a really great time with the resources boom. And now there's questions around global slowdown, or particularly China, and how Australia is going to be affected. So do you have any thoughts on Australia at the moment? Are we too reliant on construction, or are we going to make that transition to new jobs as we just spoke about?
Oh, man. Look, one of the great things about my job, frankly, in the company I work for, is I get to say I don't know a lot.
Yeah.
Where other chief economists and spokespeople have to have an answer so they look impressive and so people will give them their money. We get to say I just don't know.
Yeah.
So two answers to that. The first is firstly I don't know. The second is, look, as a long-term investor, I kind of don't have a really important tradable view or investable view on the short term, quite frankly. I've been expecting a recession for years, and that's not in a doom and gloom way, just in a, hey guys, it's been 8 years, whatever it is now, since the last one. The average economic cycle is 7 years. We've been effectively 4 cycles without one.
Yeah.
You'd be mad not to expect it. So I expect it'll happen, absolutely. Do I know when? No. So that's not very useful. And that's why I kind of don't try and trade against it. The double dip recession was supposed to hit in the US in 2010, and then RBS, the investment bank, said sell everything in January 2016, and that was a terrible call.
Yeah.
It's generally been a bad idea to be bearish, right? Eventually you'll be right, but the cost of being right, the decades of lost opportunity, when you finally get to say, yes, see, I was right, but I made no money from it, or I made a little bit of money, but I spent 20 years waiting for it in a zero sum kind of outcome.
Yeah.
So look, bottom line, I think Australia's in a pretty good position. The great thing we have going for us that many people miss is the floating exchange rate. So it's no surprise the exchange rate's now 67 odd cents against the US, because the US economy is stronger than the Australian economy. That's by definition true. Now, the beauty of that is it makes our exports heaps cheaper, makes imports more expensive. So that's an issue, of course. But that's kind of the quid pro quo, right? You get to have this automatic stabilizers, to use the economic jargon, that kind of help refloat the economy when things are tough. So our exporters are having a better time, not a great time, but a better time. Importers are having it a little bit tougher, but net, it's a positive for the economy. I do worry a little bit about the household indebtedness, and I think your viewers probably share that concern. I think that does constrain our ability to grow, just by definition, particularly in a low inflation environment. Inflation is supposed to inflate away debts. Without inflation, it's tough for that to happen. So that's a constraint on economic growth locally. I would say, for what it's worth, and I've been vocal on this for a long time, we should be, as a country, investing massively in tourism and education. They're two areas we have just obvious natural advantages, particularly geographically. We have a lot of people on our doorstep, Asia in particular, who will come to Australia. I saw some numbers out today that China's short-term arrivals now 129,000 a year. We should be able to double that and more, right? And that's something that, if we've got Uluru, we've got the Great Barrier Reef, we've got the harbour, we've got Crown, we've got any one of a million natural resources, plus frankly our own kind of lifestyle and appeal, our reputation, if you like, on the world stage. It's a pretty attractive kind of combination. So that and education, I think we should be over-investing in, for what it's worth. I expect a recession at some point. I don't know when. More importantly, I'm just not investing against that because I don't know, so I just don't choose not to. I focus on the other last thing probably is I look on businesses not at total index level. So I've never made an index call. I don't have a year-end target. I don't have a Christmas Day target. I don't have a view on what the index might or might not do.
Yeah.
I think it's more useful to think about businesses that have long-term growth potential and are trying to get decent prices, which sounds, again, a bit kind of Pollyanna, a bit easy back of the envelope stuff, but that's literally how we go about investing.
Yeah, that's a couple of the talking points I had were about education and tourism. And I'm down in Tasmania, and we've got the strongest economy now, which sort of baffles me a little bit with the latest statistics. But
and the best house prices, right? Or household price growth anyway.
Household growth going up. I think it's a bit of tourism and a bit of education. So I'm not sure if you've seen any more granular numbers about Tasmania, but I think it's what we're just talking about.
No, not recently, but I'm not surprised. There is some catch up in Tassie, honestly, as you would know. Tassie's kind of struggled for the longest time.
Yes.
They probably had one of the older economies, if I can put it that way, for decades, and so there's some catch up, which is wonderful. And things like tourism's been great for you guys. Mona, of course, has been awesome. I'm down in Tassie hopefully in January, February, mate, so we should probably get a coffee on down there. But yeah, look, and look again. So speaking about tourism education, the other thing is Australian produce exported to the world. Tassie is a clean, green kind of Garden of Eden kind of place. Again, think about the rest of the world buying Australian and New Zealand, but Australian products, exporting those to China. That should be a multi-decade boom for us when you've got food regulation, environmental kind of quality. Taking stuff to China, to broader Asia, should be an absolute doddle for Australian companies.
So just rewinding a bit with your answer around, I don't know. So putting that into your investing thesis, does that mean that you don't get overexposed to anything in, say, Australian construction or the Aussie banks, and you're avoiding those things that you don't have a thesis around?
Yeah, totally. So we have Warren Buffett talks about a too hard pile, and I'll happily throw his name in so I seem smarter. Yeah. But the old too hard pile is massive for me. Like I don't own any banks. Now that's not true. So the banks aren't a too hard question. They are literally, in my view, they are probably fairly-ish valued. So I just don't invest there. I would at the right price. In fact, we've recommended Macquarie to our members. There's a free one. Yeah. But we don't recommend any of the other 4 banks for growth. We have NAB for an income as an income option, but only a tiny allocation. So broadly, I don't expect them to deliver market-beating gains, and we're looking to beat the market. Otherwise, hey, buy the index and go fishing.
Yeah.
Too hard. Look, I don't do cyclicals a lot. We're long-term investors. I'm looking 5+ years out. Yeah. So literally, I don't know where cyclical is going to be in a month or 6 months or 12 months or 3 years.
Yeah.
If they got super cheap, I'd be if and when the next crash comes, or when the next crash comes, I'll be all over cyclicals, construction, consumer spending. If I can buy that stuff cheap, knowing that the cycles turn, when everyone else is pessimistic, that's a great time to go and buy, right? So, but we don't have any construction recs other than maybe Brickworks is probably the one, which is largely a Soul Patts play rather than Brickworks anyway.
Yeah.
For those who know those two companies, they have a cross shareholding. So Brickworks is a way to get exposure to Soul Patts and vice versa. Other than that, no construction recs. I don't love the construction industry. They tend not to be super profitable over time. Again, cyclically, you might make a good trade on them.
Yeah.
As a long-term investor, it's just, these things tend to be reasonably commoditized industries, and it's a terrible place to try and get market-beating returns.
And any thoughts around the international banks and hearing negative interest rates, and even the central banks are starting to talk about, well, hold on, this is actually hurting our banks, even though then we're trying to get money into the economy, and maybe that's not even working. So Australian banks seem a lot surer than the rest of the world, but banks globally in trouble as long as interest rates stay low or negative?
I don't claim expertise on this one. I think what international banks need is just margin, right? And so as long as they can, and again, when you're negative numbers, it's hard to do more than less than, because it gets a bit weird, right? But as long as there's a positive margin for banks between the cost of borrowing and the price of borrowing, in other words, they're lending, that's all they really need. So I'm not super worried as long as they can maintain a positive margin and a decent positive margin that covers their risks. Now, if they start to make bad loans, that's a problem. If that margin gets compressed because, frankly, just the whole thing gets so messed up, no one really knows what's up or down, that's where it gets messy. I think the longer we have negative rates, the riskier that is, because we're in uncharted territory, and you end up being boots deep, then knee deep, then neck deep. If something's going to go wrong, by the time you realise it may well be too late. So I'm not super worried about it, nor am I rushing to invest in them, though, quite frankly. I'm happy to leave that for somebody else.
Yeah. So in terms of Australia and the monetary policy at the moment, I was always sort of the opinion that we're going to have QE and rates are going to go low as the rest of the world is going down that path. So do you think that is going to help the market? I mean, one of my theses has been switching from being fairly bearish a few years ago to saying, well, hold on, if they're going to keep printing this money and it's going to happen in Australia, we haven't even made new highs on our index. Why on earth isn't our index and our asset prices just going to go up? And the RBA probably realise that's going to happen. But do you think that QE is good for all asset prices as a general rule of thumb?
Well, in the short term, absolutely it is, almost by definition, right? Because for those who believe in the theory of market pricing, and I think that we're not efficient markets guys, but generally markets are pretty efficient most of the time. So you kind of take that broad approach, knowing there's going to be massive outliers, which is where we try and pick stocks. Yeah. But separate to that, the market will reasonably pay more for assets when the price of that borrowing is cheaper, right? The old discounted cash flow, net present value stuff that you may or may not want to talk about. But basically the idea is, the cheaper rates are, the more you should be able to pay for the same asset. Yeah. And so if you get QE, effectively that's negative rates by another name, and you should be able to pay more for those assets. Now, over time, that's got to reverse at some point, right? So if you're looking out a longer term, the risk now is you buy at these rates, as and when rates do increase. Now, maybe they decrease in the short term, maybe that's where the money's made, but as they then start to normalize at some point, maybe that's 3 years, 5 years, 25 years, 100 years away, whatever it is, if and when they start to normalize, then you're actually swimming into a decent headwind, and that's kind of the risk, right? So it means we need to be a little bit more careful how much we're paying for assets. We can afford to pay more because the market's going to value them more highly, but also the more you pay now, the market will simply reverse that view as rates go up. And unless you're able to get out, or unless the company's asset or profit growth is faster than the market or faster than the increase in rates, you may still struggle to make a profit. And that's, they've been lost decades equities wise. Japan, of course, is particularly one, but even the Nifty 50 stocks in the US in the 70s, same kind of problem, right? They went nowhere for a decade because they were simply valued too high. There's no reason why that couldn't potentially happen. Now, again, am I investing that way? No, because I simply don't know if, when, and how. And frankly, I don't know where there's a better long-term investing option. So you're still in a relative world. In that relative world, I still think stocks are probably the best place for most people for my money. But yeah, look, the QE is an issue. I will say, for what it's worth, monetary policy-wise, the big elephant in the room, and without getting political or ideological for a second, the big elephant in the room is still fiscal policy. And while many European countries don't have that flexibility, we now have a balanced budget effectively. Yes, we have some decent national debt, and that's not nothing. Yeah. But I think the big risk now is that, Phil Lowe's pushing the lever. He's got one lever, right? You got to push it up, down, or hold it where it is. Yeah. I liken it to he's flying a biplane while the federal government's flying a jumbo with dials and knobs and switches and screens and God knows what. Again, ideology aside and political preference aside, whichever government's in power, whichever party's in government, the key question is, what are they doing to take some of the pressure off the need for QE and lower rates? I do fear, you're right, Lowe is pushing up asset prices. I'm absolutely dead sure faster than he wants to and is comfortable with. But he looks around and says, well, guys, if you're doing nothing, I've kind of got this mandate, and if you won't do it, I guess I have to. Yeah. So I think policy-wise, we're going to put ourselves in a much more precarious position than would need be if the pollies were awake.
Yeah, I couldn't agree more. One of the things I've been talking about is that relationship between Lowe and Josh Frydenberg. It's kind of becoming the old Trump, power over there, where they're really at each other. And I see it as the same. There's no point starting QE and printing money if the government is running a surplus. Like, it just doesn't make sense.
Exactly. I mean, it's not just Lowe, by the way. This was Glenn Stevens, way back in his term, a year or so, maybe 2 years before he resigned, was already belling the cat on other agencies doing more. Now, APRA finally came to the rescue, or came to the party, frankly, with macro approval rules. But even before that, Stevens has been saying to people, "Hey guys, I need your help here. Like, we're doing what we can do. I need your help." And it's a challenge. Like, I love independent central banks. I think they're really, really important. But it's the challenge when a politician who's got a 3-year term can say, "Hey, I'll leave it. I don't want to touch it. Not too hard for me. Yeah. You'll do something, won't you?" No fool that he will. Of course, Lowe will do something. He feels like he has to. Yeah. And kind of not exactly damn the consequences, but he can't control the consequences. All he can do is say, well, if my job is more inflation, more employment, then I've got one lever to do it. And if you're telling me I have to hit that mandate, then I'm going to push the lever because that's what I've got. But geez, guys, I'd happily either pull it back or leave it in neutral if you guys would actually go and do something over there. So I think you're dead right. I think that the government's... Now, look, there is a view, by the way, the economy is not as badly placed as many people believe. And if that's true, then maybe Frydenberg's right not to do anything at all, because things will start to improve. And we're seeing house prices already on the improve. We're seeing business confidence generally pretty good. It's been a bit patchy. Some are positive, some are negative. But if that's true, then maybe he is right to say, well, let's just give this some time. But I dare say when Lowe says this is desperate enough to push rates down to where they are now and possibly one more, it probably is way past time for the government to add some, frankly, do some heavy lifting when it comes to doing something to stimulate the economy.
Yeah, and I think like longer term, not having that huge government debt compared to the US is going to be good for the economy and actually good for the Aussie dollar. It could get very strong.
Yeah, and I think that's right. How we get out of this is really fascinating, right? So the key question really is inflation, and we all know. And again, I'm not saying anything you don't know or your viewers don't know, but inflation hasn't turned up, and no one really still knows why. There's lots of speculation, lots of theories. In 10 years' time, we'll look back and say, that was why, and we'll know exactly. And we can all theorize, but the challenge right now is right around the world, lower rates just aren't doing anything. I mean, unemployment's falling dramatically, particularly in the US. We should remember too, by the way, that I think we're kind of caught up to some degree. We've kind of drawn a line between pre-GFC and post-GFC history-wise. If you go back any time before or up to about 1970, this level of unemployment is unreasonably low. We haven't had sustained unemployment at 5 point something, probably for 45 years before the current sort of cycle. Now, post-war, very low, got high in the 70s. We've been, on effectively a 40-year downward trend on unemployment. So if you said to anybody at any point before the GFC, hey, would you like 5.2% unemployment? They say, yeah, sure, but rates would have to be at 4.5%, 5% to keep the economy in check, right? We've had that unemployment. We're doing well. GDP is okay. There's some brittleness again. But I'm not entirely sure there's this massive issue that maybe some people foresee. Unemployment's low. The participation rate is record highs, I'm pretty sure, at least very close to that. So whatever kind of weakness we think we see, the real risk is inflation. Until that kind of comes back, central bankers will remain nervous.
So are there any sectors in particular that you'd want to highlight for the viewers that interest you? Is it healthcare and that sort of medical research that Australia does well, or even globally? What are your favourite investing themes at the moment?
Wow, great one. So look, I will say I bang the drum a lot on international investing. And so from the ASX, if you're only investing in the ASX at the moment, grabbing a US index, the NASDAQ 100, an S&P 500 ETF, a developed world as a Vanguard ETF. I should say, for the record, I own both the NASDAQ ETF and a rest of the world ETF. So for full disclosure, I own those two equities. You want to be invested. The companies, if I'm worried about anything about the ASX, not worried so much, but you think about the weight of the ASX, right? If you're investing only in an ASX index, 2/3-ish, maybe 60% of the index is made up of financials and miners. So those two sectors, right? And the vast bulk of that is financials. If you look at the top 20 stocks in the ASX, they make up 2/3 of the market's market cap. And so you've got a super, super concentrated market by size and by industry. And then, as we talked about banks, then if you take a view that I do, which is banks won't deliver particularly strong growth over the next 5 or 10 years, then effectively what they're doing is saying that there's going to be an anchor on the market where around, again, depends on the numbers, depends on the day, but between 35 and 40% of the market is going largely nowhere. How does the market as a whole grow with that anchor? Now, it still can, by the way, and it still may. But if you look at that side by side, it makes international investing look pretty good. The companies that are inventing the future, again, it sounds a bit jargonistic, a bit marketing, but if you think about the products and services that we use, the Netflixes, the Facebooks, the Googles, the Amazons, the Apples, a million of them out there, right? These are the companies that are literally inventing the future, that are shaping the way we do our thing. You want to be invested in some of those. So the first is international investing is probably the big theme, and US in particular, but international broadly, I think is smart. And frankly, as you say about the Australian economy, if we are in any sort of trouble, now maybe the rest of the world's in more trouble, by the way, but when, Australia was 2% of the world's equity markets, and yet somewhere around, for most people, 90+% of their portfolios and maybe 80% of their super is invested on the ASX. And if you said to somebody, I used this example the other day, right? If you took the entire 1,800 odd equities on the ASX and said, I'm going to arbitrarily pick 2% of them, and you can only choose from that group, you'd call me crazy. And you'd be like, well, I'm not doing that. That's stupid. And then if I said, okay, well, let's assume you're a world citizen for a second. If I told you you can only invest in 2% of the world's equity markets, again, chosen arbitrarily, not randomly, arbitrarily, I'm going to pick one country before you can invest in. If I said to you, all you invest in is India, that's it. Do you want to do that? Well, no. What about Chile? No. Well, what about Singapore? No. Well, then why just Australia? And the answer is, well, because we live here, which is a really crappy reason to invest in at all. So international investing is one. The second for me is, you talk about medical tech. I think there's some really exciting stuff going on in medical tech right now. Nanosonics is one that I really like. I think it's a great business, a bit going there. CSL is a high quality business, but always been bloody expensive. So that's good. I actually quite like this consumer discretionary from a valuation perspective. So I kind of like to find growth and value in different pockets, and I do a bit of both. Value-wise, some of that consumer discretionary stuff is about as cheap as it's been for a long time. Now, if recession hits tomorrow, it looks expensive, and maybe it still is. But if you're a long-term perspective and you can buy high quality consumer discretionary for a cheap price, then I'd be grabbing it. Kogan is one in particular, again, that I like. Bought at lower prices, so it's got up a bit this year, but it doesn't have to beat Amazon. If it could be a number 2 to Amazon's number 1, if that's where we end up, then it's still going to do very, very well. If it does beat Amazon, then even better, in Australia at least. So that's an attractive business. I like that one a lot. So they're probably 2 areas. I'm not a thematic investor for what it's worth, despite me talking about those things. I do try and do kind of company specific rather than picking a theme, because in any theme there are still good and bad investments. The last one I will say, though, again, so much as I say, not thematic. I talked about clean green Australia to the world. I think China's consumption of Australian branded goods is going to be a long-term bull trend. So again, wherever short-term, who knows where the share prices go? Who knows where the profits go in the short term? But Treasury Wine Estates, the winemaker, Penfolds, Lindemans, Wynns, Bellamy's, Blackmore's, those sort of businesses, I think have a pretty good long-term trend. Bellamy's, of course, been taken over, so it's no longer investable. But the Chinese appetite and the broader Asian appetite for that stuff. Super, super important. And again, I'll disclose I own Treasury and Blackmore's for full disclosure. But those are businesses I think are, and again, I don't know what happens next year, I don't know what happens the year after. But if you say to me, look, in 25 years' time, which companies do you wish you would have owned back in 2019? It's just hard not to look at those companies and say, man, how is China not going to drink a hell of a lot more Treasury wine or take a lot more Blackmore's vitamins? Now, there's reasons why they mightn't, and it still might fail. But conceptually, if you said, look, are the odds in your favour, you'd be pretty confident, I think, that demand should continue to grow.
Yeah, just in terms of technology and exposure to being able to invest, I think that hasn't been that great in Australia compared to the rest of the world. Like we've just partnered with eToro, full disclosure, and they've got, I think, a good product. But in the US, there's so many apps, and I'm sure there's going to be way more coming to Australia. And I clearly remember having to pay like $20, and there was a $500 minimum to buy my first shares. And I thought, this is crazy in terms of percentage terms for the small guy. So do you think investing and managing your own money and all that is just really opening up to the general public?
It really is. And look, we know in the US now, equity trades are $0 for the 3 big brokers. I mean, that doesn't get much cheaper than free, right? I mean, it's not exactly free. There's strings, but effectively call it free for our purposes. I think we'll see more of that. I don't know whether we'll get it to Australia anytime soon, but even then, you can invest in Australia for $14, $17, $19. Comsec, a new pocket app, and again, we're not affiliated with them at all. Just happen to have one, which is free to invest in 7 ETFs, I think, for $2, sorry, a trade or whatever. It's like just stupidly cheap. So there's now more and more ways to invest inexpensively. Again, I would say for what it's worth, if you can buy $1,000 worth of shares every couple of months or something, and you can do that for $20, 2% is not a bad in, particularly if you're a long-term investor, right? If you're going to trade in and out, that's going to kill you. But if you're going to buy stuff, you're going to hold it for 5 years, and maybe it doubles in that time or something like that. That's a pretty attractive cost base, really. If you think about, let's say, again, arbitrarily, let's say it doubles in 10 years, just to the exercise. The 100% gain minus the 2% transaction cost, still well and truly worth doing. But as you say, I think lowering the frictional kind of costs and the reasons why people don't trade, I think is a net benefit for everybody.
Yeah, and I think a few of those ones that are coming to Australia are going to work on that $0 fee thing. So that's great for getting the small guy in, I think. The next thing I wanted to just ask you about was crypto. So I know you guys were probably getting a million questions, and at the time I was kind of a little bit like, oh, here we go, Motley's jumping on the crypto bandwagon. But I took a step back and thought, oh, I'm probably being too harsh on them, because I'm sure you're getting a million questions, and people aren't going to trust a guy called Nugget with Bitcoin toys on the shelf. They want information from their trusted source.
The bloke with the jester's cap behind him. I'm not sure that's much better, but I'll take your point.
So what were your thoughts around crypto, and longer term, are you still thinking that maybe this is a new asset class and Bitcoin's worth a play, or
so look, as long-term investors, again, Bitcoin's kind of I don't know right now for me. What we did do is we released a guide. I was paid, but a paid guide back in, was it 2017? Maybe end of 2017, I think. Which was basically, as you say, that the idea from us was basically, if you're going to do it, then at least have someone you can trust. Not say other people you can't trust, but if you don't know who to trust, then we'll give you some way of knowing, right? If you come to us for advice, as you said, like so many, like just flooding questions of what about this, what about that, what about this, what about that. And so what we did was basically, we didn't formally recommend any of the cryptos, but we basically said, look, here's a way to think about crypto. Here's a way to choose a wallet or a broker. Here's a way to go about thinking about the space, investing in the space. Here are some potential equity style plays, particularly in the US, that are playing on the crypto theme, whether they were exchanges or businesses that were, investment banks or others that are getting into the space. So that was kind of the way we looked at it, was to basically, we were never going to be the boots in, high risk, take a punt type stuff. That's not our business model. But we wanted to help people understand it best. If you're going to do it, it's the old thing of don't do it if you're going to, then at least be safe. Almost not the drugs message, right? The abstinence message. Abstinence is better, but if you're going to do it this way. So that kind of idea was, just be careful as you go, and here's a guide to help you do it. Fast forward now, look, I still don't know. I still don't know where this nets out. I don't claim to be an expert in crypto or Bitcoin. I just don't have a strong view. So for me, I have about $100 worth of crypto to kind of be part of Bitcoin, to be part of the game.
Yeah.
Again, about 18 months or so ago, I still own it. I make the joke regularly. I bought it through Coinbase, and you still can't sell it. So I still have those Bitcoins somewhere.
Yes.
I changed my phone about 8 months ago. I haven't updated. I haven't even reinstalled the app. That's because I still can't sell, so I'm not bothering.
Yeah.
But at some point, I'll do that and do something with it. For me, it's a watch and see. I think Bitcoin makes a heap of sense as a replacement or substitute for gold once the price stabilizes. Now, so that's asset protection, right? Now, that's not speculating where the price goes next. So I have no view of that. But over time, if you think about why people like gold, for all the reasons you love gold, plus, by the way, Bitcoin's got some extra benefits, like it's completely transportable. It is anonymous for those who want it. You can move it around, deposit it here and there. So it's kind of gold on steroids to some degree. Now, that brings a risk in the short to medium term because we don't know where the price settles. So if the price settles at a 10th or 100th or 1,000th of the current price, then it may still function as a substitute for gold, but at a heaps lower price.
Yeah.
Of course, it could add a couple of zeros to the price too and stabilize at that level. So while we're in this kind of, everyone's digging up gold. If we go back to that kind of time, literally the whole mining term is really, really, really valuable as an analogy, right? Because it is that story of what's the price of gold? Well, it kind of depends how much of it there is and how much people want to pay for it and how much people care about it. And at the end of the day, gold's not worth anything either, except that other people want to pay something for it.
Yeah.
And so we have a market price, which is kind of loosely based on the price of production, and the fact that it's worth something both as something that, a precious metal, as a piece of jewelry, but also as a store of value. So I get the value of crypto in general, Bitcoin specifically. I love the idea of blockchain as a tech. It's just really super cool. And I think at some point we may yet see commercial applications of the blockchain technology of one description or another.
Yep.
But right now it is just too hard for me, which I know is going to have plenty of your viewers scoffing and talking about my ignorance, and they're probably absolutely right because I don't claim to know. But I'm happy to say, look, guys, knock yourselves out, go at it. Someone will make a fortune, and good luck to them. If you know it better than I do, then that's where the money's made. It's important in any investing to play to your edge or your circle of competence.
Yes.
Bitcoin's just not in mine. So I'm super interested in it. I think it's a great story, great tech, super cool invention. Love the whole concept.
Yeah.
I don't know if it's investable for someone like me yet.
Yeah.
But at some point that may well change.
Yeah, and just quickly, obviously you're getting all those messages we just spoke about, and that died off in crypto winter. And I think the run from 3,000 to 14,000 US, it was kind of a lot quieter. Like, I'm not sure if you were getting a bit of an uptick in inquiries, or did that all die off again and now it's died off, or how'd that play?
It's funny you say that because that's exactly, the public attention. You guys were this better than me, frankly, because you've been at the cutting edge of it. But we see these booms, right, in investable ideas, and so when the public, it's not even Bitcoin versus shares. It's a type of share, it's a type of stock, it's a something, right? So we've had lithium, we've had graphene, we've had
marijuana,
nickel, we have pot's the current one, right? And Bitcoin's kind of was kind of a sandwich between those two. It was graphene, I think, then Bitcoin from memory, or maybe they were around the same time. There's something that grabs the public's attention, and then it gets in the mainstream media. I think that's the difference. We haven't had the mainstream media kind of grab this because pot stock's been where it's at. Everyone's talking about pot, particularly in the US. We get most of our themes from there.
Yeah.
Graphene, by the way, still a cool tech. Lithium will absolutely be huge as a energy storage source.
Yeah.
Marijuana won't go away anytime soon. There'll be more states legalizing more of it in the US, and then probably more countries, and I dare say we'll be there eventually nationally.
Yeah.
These things do come to fruition. It doesn't necessarily mean they're investable. I don't think lithium is investable, but they'll happen. Excuse me. But in the short term, it's the market kind of overexcitement about maybe this is the next big thing, and stories sell. We know that.
Yeah.
So they absolutely grab the headlines, and again, there's always a kernel of truth in every good story. It doesn't necessarily make it investable.
And just quickly, I don't want to keep talking about crypto, but would a Bitcoin ETF or, say, a Bitcoin top 10, would that make you more likely to do it personally and recommend it to your clients and say, look, let's get a bit of blockchain exposure. There's an ETF. I don't have to worry about my Coinbase and blah, blah, blah. Do you think that is going to be overall good for the market?
Good for the market, yes. Would I do it? No. And look, frankly, I want to draw a line between Bitcoin versus shares. Because it's not really that. I don't invest or have any of our clients invested in gold or silver or platinum or any particular commodity.
Yeah.
Just because I don't expect it to be an outperformer over the long term. Now, again, Bitcoin aside, the idea of a commodity is they're normally reasonably priced, and frankly, they're relying on supply and demand, and prices swing all over the joint.
Yep.
Traders make a fortune if they do it well; they lose a fortune if they do it badly. I don't play that game, and so for me, it's not a case of I don't like Bitcoin because, I mean, it is to some degree, but it's like, for me, that's an equivalent, or again, not equivalent. I have people yelling at me, but it's in a similar asset class to the golds and silvers and platinums and irons and everything else. Is I don't touch. So I'm looking for businesses with pricing power who can grow earnings over time. Bitcoin doesn't meet that, nor does gold, nor does iron, nor does anything else. And so for me, it's kind of an easy way to put the two hard baskets. I just don't invest in those kind of things. To your point, an ETF would be a cleverer, smarter, less risky way to do it. Of course, there's always the risk that as an asset, the ETF may well be either under or overvalued if the long-term underlying value of these things is much higher or much lower. And again, I don't have a view on which way they go, but the ETF takes away some of the risk, some of the kind of the coin or the exchange or the wallet-specific risk, but doesn't necessarily take away the risk of what 10 years time we look back and go, man, this conversation was prescient. The price then crashed by 90%, or it went up by 100% or 1,000% or 1,000,000%. If only at that point we'd done X. We just can't know which way it's going to go, and everyone's got their view, and that's completely okay. For me, particularly as an advisor, my job is to understand the risks I'm exposing our members to and recommending accordingly. So we lose money from a decent number of our recommendations. So I don't want to say we always make money. We're super transparent. Right? We're right about 6 times out of 10.
Yeah.
Those 6 times, by the way, have us beating the market. It's important I say that too. Share advisor that I run's been going for 8 years. And we've beaten the market by a decent margin across that time. But we've got plenty of losers in that mix as well. But broadly, the test I apply to myself when I make recommendations is that if a member says to me, hey, this lost money, didn't you see this coming, or couldn't you have known that, or why did you take that risk? If I can't explain clearly this was a risk worth taking because X, then I have no business recommending that stock. And that's kind of the same way I approach commodities and the same way I approach Bitcoin.
Yeah, that's the same for us. I mean, we try and do a lot of fundamental research, and we've had a good record, but the people certainly like to remind you about the losers as well.
And that's it. And that's human nature, right? I think there is some reality to, for all of you, I'm sure you want more business rather than less, but for some of you viewers now, if it's not your thing, don't do it. Like go and find a way to invest otherwise. I tell our members, I tell our readers all the time, not good for business, but it's like, if you don't have the stomach for this, don't do it. Like, please save yourself. The last thing I want to do is entice you into something that you're going to go and lose money not because I was wrong, right? I'm actually right more than wrong. If you only buy the one stock you see the first time you join, or you pick 3 out of our 70 odd recommendations and say, well, why do they lose money? I know I will lose money 4 times out of 10. If you're buying 1, 2, or 3 stocks, you are literally playing dice. And I can't help you. Maybe you'll make a fortune, maybe you'll lose a fortune. I just don't know, and I can't help you on that one. So, if you're that sort of person, go on. From a stock perspective, go and buy an ETF. If you don't want to do that, diversify across all sorts of assets and go and invest. Right? If you've got viewers now watching this who just feel like, well, it's kind of a bit of fun, but I'm a bit scared, or I know myself, and I know that if things get bad, I'm going to sell in a panic. Whether it's Bitcoin, whether it's shares, whether it's property, last thing I do is selling in a panic, right? That's just madness. So if you don't have the stomach for it, please don't do it. If you do have the stomach for it, then make sure you're not fooling yourself, but make sure you see it through.
Cool. Well, Scotty, I will put all the links to your Twitter and the website below, but any final message for people at home?
Oh, I mean, thanks for watching, firstly, and thanks for having me on. By the way, I know this is not your core business, your core audience. We had a bit of an exchange on Twitter, and you were very, very kind to invite me on and have a chat. Yep. I think at the end of the day, what I've taken out of this, frankly, is a lot of our kind of fundamental approaches aren't that similar, right? We've talked about stuff and agreed more than we've disagreed. Just from different perspectives. I think that's probably the key. Is good investing, regardless of the asset class, isn't all that different. It is based on fundamental research. It is based on understanding the asset you're buying, the pros and cons, the risks and opportunities. I guess for me, the answer is long term. It may not be for everyone who's maybe trading on your advice or something else, but if you're investing in stocks, unless you believe you can know where things are going to go and you have some reason to believe that's true, long term for me in equities at least is the answer.
Fantastic. Yeah, thanks so much for joining us today, and I'm sure everyone at home has enjoyed that. So cheers, Scotty.
Thank you.
Cheers.